Well, welcome. I'm excited to be joined today by Guy Davis. Guy is the portfolio manager and managing director of GCI Investors. They're a Houston based investment firm, and he is also the co author of Navigating the Street, A Better Approach to Investing. This is a book that I highly recommend. I'm about 3/4 of the way through it, and I've only had it a couple days. So, highly recommend people take a look at that. My name is William Hild. I'm the executive director of Consumers Research. Our organization exists to inform consumers about issues that are important to them and help ensure their rights to act on that information in the market. And I have asked Guy to join us today to talk about a very important issue facing retail investors in regards to investments in China. And he's been generous enough with his time to come join us. Before we get started, I just want to note that none of this should be taken as investment advice. I don't hold any credentials, and that any of the views expressed on this cast are that solely of the participant and not of their organization. With that out of the way, Guy, thank you so much for joining us today. Really appreciate it.
William, thank you very much for having me. I'm pleased we got a chance to sit down and discuss this issue. I think it's an issue that should feature an awful lot more in the press publicly, and I'm glad we've got this forum to bring it to people's minds.
Absolutely. Well, by way of place setting, the issue that we're talking about today are called variable interest entities. And I'll let Guy define what that means and why they're called that when we get to that point. But generally speaking, this is the first of our series on issues related to dangers to retail investors with investments in China. Obviously, China has been a place of incredible economic growth in the last few decades. And as such, it's attracted capital from across the world, but namely the United States, and increasingly retail investors find Chinese equities in their portfolios. And so we wanted to bring this series as a way to educate investors so that they can be properly armed with that information as they act in the markets and as consumers in the retail space. So let's get started here, Guy. Why do VIEs exist? What purpose were they trying to serve when they were created?
Yeah, it's a great question. The variable interest entity is a legal structure that's been around for quite a long period of time, but it is now most commonly associated with China and exposure to Chinese companies in particular. The reason that it is so widely used in China is that under Chinese law, something called the Foreign Investment Law, also known as the FIL, the Chinese government restricts foreign ownership in certain industries within China. Now, they do this to maintain internal Chinese intellectual property, to ensure that that is not distributed elsewhere, and to ensure that they can exert the appropriate amount of control that they need to over enterprises. There have been various changes to this law over the last 15 or 20 years or so. Most recently in 2020, an awful lot of people were expecting that the law would begin to be softened and open more investment to overseas companies. In some areas, that has been the case, but there are still many industries, technology, large parts of energy, telecommunications, where foreign ownership is either very strictly controlled or completely prohibited. And what that means is that for us as non-domestic Chinese nationals, there are certain companies and certain industries in which we are not able to take ownership stakes. In the sense that with a US company, if we want to go and buy shares in Facebook, we're perfectly freely able to do so. So is really anybody else in the rest of the world. That's not allowed for certain Chinese industries. Now, back in the kind of the 80s, I would say is really when this began to take off. China was going through a significant economic boom, very attractive to an awful lot of US investors looking from the outside in terms of the tremendous growth that was going on. And from the Chinese perspective, the huge amount of capital that was available in the West was very attractive to them. And so companies began to use the VIE structure as a way to circumvent these foreign national ownership rules. What the VIE structure does effectively is it sits in the middle, in between the domestic Chinese company and the Western investors. And it's a very strange structure in the sense that it says different things to different people. It says to the Western investor that you own stock in the Chinese company, and it says to the Chinese company that it's wholly owned by Chinese nationals. And the way the companies do this is that they create a new entity, usually in the Cayman Islands. It is a shell corporation. There's no office, there's no assets, there's no employees. It's simply a corporation on a piece of paper. And they name it the same name as a Chinese company. So we could take Tencent as an example. Tencent is a real Chinese company owned by Chinese nationals. There is a company called Tencent that is registered in the Cayman Islands. The Cayman Islands Shell Company then lists its shares for sale to Western investors. Western investors buy stock in this Cayman Islands Shell Company. Now, the only reason this Cayman Islands Shell Company has any value is because it has some contracts and legal agreements with the domestic Chinese company saying that it has a right to profits and cash flows from the domestic Chinese company. So on paper, it appears as though if you're a Western investor, you're buying stock in the shell company, but the shell company has the rights to the profits from the real Chinese company, so you should be okay. That's really the kind of the basic premise of the VIE structure, and there are now hundreds of VIEs listed in the US and listed in Hong Kong.
So let me stop there just for a moment because I want to drive this point home. What you're saying is that when a retail investor goes online to their brokerage, whether that's Vanguard or BlackRock or what have you, and they purchase a share of Tencent or Alibaba, they're not actually purchasing a share of the Chinese company. They are purchasing a share of a Cayman shell corporation that's got the same name so that it links back to the Chinese corporation. And that is to the extent that we'll get into the problems with that, but to the extent what it's structured to do is be equivalent because you've got the right to some of the profits of that company that are more or less equal to a share of that company. Is that correct? Is that the idea behind a VIE?
That is absolutely correct. If you or I or anybody watching this logs into a TD Ameritrade or E-Trade account today and types in BABA, the ticker, they will see Alibaba and they could go and buy stock in that. And it very much looks and feels like you are buying stock in Alibaba. In reality, you are buying stock in the Alibaba VIE listed in the Cayman Islands. Now, if you look up all US listed companies have to provide certain documentation regularly. 10K is the kind of the annual report. You will see in very small print at the top of the annual report, it will say Alibaba, a Cayman Islands listed holding company. But really, unless somebody takes the effort to do that, no. Most people, when they are going and placing these orders, would have no way of knowing that they're actually not buying Alibaba itself.
Got it. Well, you've just told us, why they created VIEs. We've talked through what is a VIE. Why are they structured in the Cayman Islands, for example? What is it about that location versus a U.S. If they were created a U.S. listed corporation? Is there a reason they're in the Caymans?
It's really for ease of use. I mean, there are certain jurisdictions like the Cayman Islands, Bermuda, Panama, places like that, where there are less checks and balances that go on, and it's easier to create these shell corporations, have them offshore. And so it's a simple, easy process. And certainly if you go through the Cayman Islands companies that arrange this sort of structures, there's a huge business now in VIEs for them. So it's very much kind of become the home of the vast majority. So the bulk of them will run through the Cayman Islands. And in reality, they have no operations there. There will be a listed office, but it will be the same listed office as 200 other corporations.
Right. So it's similar to registered agent services. You might have one law office or one registered agent. Exactly. And Cayman Islands probably has 200, 300 Chinese, or I shouldn't say they're not Chinese listed, Cayman corporations with profit sharing structures with these Chinese corporations.
Exactly. So, and then typically the next stage from that Cayman, they will be then listed directly on US exchanges or often on Hong Kong exchanges as well.
Got it. So from there, the Cayman Islands Corporation is listed. Now,
correct.
In retail investors, as we noted before, they have access to this both through their individual brokerage accounts, but they're also probably exposed to some of this as far as ETFs. So, like sometimes they own funds, correct? That would include some of these. What are some of the risks to retail investors? Obviously, that's the purpose of today's discussion, not to just explain the structure, but to go into some of the problems that retail investors might hit if they have their assets in some of these companies. Can you talk about that?
Yes, and certainly I would say many retail investors will be invested in VIEs probably without even knowing it. The largest kind of indices, certainly if you look on the kind of passive investment side, most of the emerging market indices now will include China in some way, shape, or form. And the only way that US funds or ETFs or trackers can get access to these Chinese companies is through the VIEs. If you're looking at an emerging markets mutual fund, and you're looking at the fact sheet and you see the top 10 holdings, and it's got Baba and it's got Tencent and percentages there, it's remarkable, and personally I think slightly terrifying, that there is typically no declaration of the fact that those are the VIEs, not the underlying companies.
Right.
So
it's like there should be an asterisk next to all of those stock tickers.
I 100% believe there should be a very clear indication that if you're putting Alibaba next to Apple, for example, the two are very different things, and people should be made aware of those very different things. So lots of end clients will hold these things directly because they own the funds themselves, or they will hold them through their 401k plans, their retirement plans, whatever it might be. They will hold them through funds that are managed by RIAs, and people typically don't know what they're invested in and are not appropriately warned in my regard.
And our discussion today is aimed at retail investors, but likely you might have people with state pensions or for-profit non-government pensions, and they're probably, some of that pension fund is probably tied up in some of these companies as well.
Almost certainly.
Yeah. Give me the bad scenario. What you've got this sort of Rube Goldberg machine structure. You can't own Chinese equities. Are these VIEs respected in China? Are these something that they've accepted, or are they sort of on a precarious footing?
Yeah. So I think there's two main problems with the VIE structure, and then I'll talk through kind of the most common reason people give for why they're okay and why we shouldn't be worried about the risks. First of all, the VIE structure itself is fundamentally illegal in China. Within Chinese law, there is a very specific statute that states if a contract is created with the express purpose of circumventing a law, the contract itself is invalid. It's very similar, it exists within US and English law, very similar concept. But what it basically means is that the contracts that exist between the VIE and the domestic Chinese firm are very clearly in place solely to circumvent the foreign ownership rules. So on that very basis, the contracts themselves that give you a right to the profits are legally unenforceable. Now, we've been through, and there are a number of examples of court cases over the last 10 or 15 years of where things have gone wrong with VIEs and people have tried to enforce the contracts, and they have been proved many times to be legally unenforceable. So that's the first problem, is that you have a structure that is fundamentally illegal. Now, what that means is, A, you can't enforce anything if anything goes wrong, because technically you don't own anything. You only own shares in a shell company. You don't own any of Alibaba. Secondly, it means that you are very exposed to the whims of the Chinese government and the Chinese regulator. And we've seen examples in the past where they have kind of selectively chosen when to enforce the VIE rules. In reality, for the majority of the last 2 decades, the Chinese regulator has turned a blind eye to VIEs. They are fundamentally illegal. You speak with any Chinese lawyer, they're pretty obviously illegal, but the regulator turns a blind eye and allows them to continue. There have been selective examples where they have enforced the rules and either stopped companies from listing, such as Ant, or Alipay, which we can talk about, kind of was about to IPO recently. So they'll either stop a company from listing, or they will very occasionally kind of heavily restrict or even delist a company that's already in existence. It's very difficult for us on our side of the pond to know when that's going to be enforced and on which companies the Chinese regulator are going to decide to enforce its own rules. So I would say that's the biggest problem, that the companies are, the structure is illegal. We don't know when it's going to be enforced. We're also facing what is arguably, I would refer as kind of a nuclear option, in that the Chinese government could quite legitimately turn around and enforce its laws on all of the VIEs, at which point it would wipe out about $2 trillion of investments on the US stock market. Now, I refer to that as a kind of a nuclear option on the basis that the majority of people you talk to will say the Chinese government would never do that because the political ramifications of such a move would be enormous. And I don't disagree with that in terms of a statement, but it is a risk that arguably they have that card to play should they wish to.
Certainly. Well, let me ask this. Could they selectively enforce it against one nationality? So, for example, if the United States and China were to continue to become more bellicose in their international relations, couldn't they selectively just say, okay, now all American nationals do not, if you're Indian or you're British or you're Swiss, sure, your money is safe with us. The VIEs you have with us are still valid, but anyone from the United States, those are no longer going to be honored. They're all null and void. Is that something they could do?
I mean, it's possible. It would almost become a little tricky for them because once the VIE is listed on the US stock market, then anybody can invest in it. And so I think the best way for them to do it is based on listing jurisdiction. So they would have to determine it based on the US listing or Hong Kong listing or whatever it might be. But it's quite difficult for them to do it very selectively simply because the VIE structure is so widely used. Now, they have done this over the last 15 years or so, and they've picked out individual companies here and there. But it's quite difficult to do because if you pick on one, it's then very difficult to turn around and say, well, the other 5 that look exactly the same are legitimate and allowed to continue.
Right. So what we've talked about some of the risks. Are there, and you've alluded to some concrete examples of this. Are there any particularly notable times when this structure has been leveraged by the Chinese government to get their way?
Yes, and there's one more risk that I just want to touch on. So aside from the kind of the fundamental illegality of the structure, you have the second risk is that we have very little protection as investors because we don't fundamentally own any of the underlying assets, and that opens up the possibility for assets to be removed or stripped or taken away from us, regardless of the government. The individual company has the ability to do that.
I see.
There have been a number of examples that you asked about examples. There's been a number of examples of when that has happened. I would say the most common and well known and one of the most interesting is Yahoo, Alibaba, and Alipay back in 2011. So we talked about Alibaba earlier. Many people would kind of regard Alibaba as the Amazon of China. It's probably the Amazon plus the Facebook plus the PayPal plus various other things of China. Okay. Alibaba created a payments network called Alipay, which is effectively MasterCard, Visa, Stripe, all rolled into one. It grew to be a very significant part of the value of Alibaba as a whole. Yahoo was an investor in the Alibaba VIE back in 2011. Now, during 2011, Yahoo discovered during that year that earlier in the year, about 6 months earlier, Jack Ma, the owner of or the founder of Alibaba, had transferred all of the ownership of Alipay, this payments network, to a third-party company in which he was the sole owner. Now, at that point, Yahoo had around a 43% stake in the Alibaba VIE. So they were a very significant shareholder. They did not even know about this transaction until many months afterwards. And of course, when it happened, they were obviously extremely annoyed because a huge part of the value of their shareholding had been completely removed. There were various legal battles, various kind of court dramas that went on. Jack Ma eventually ended up making a settlement payment offer to Yahoo, but it was, I would say, extremely small in comparison to the underlying value of Alipay, and it had a significant impact on Yahoo's profitability. Yahoo's valuation. The CEO of Yahoo was fired reasonably shortly afterwards. And what realistically happened when you boil down to it is that you had a very valuable part of a company was effectively taken away unilaterally without any shareholders having any say over it or any control. And there are a number of other examples of kind of asset appropriation like that under the VIE structure, because technically, as an owner of the VIE, you have no rights or control over the underlying assets. So if the owner and the founder wants to take chunks of the company, parts of the company, whatever it might be, and transfer them somewhere else, you don't have any say. You have no recourse. So that's the other significant risk, I would say, that people face with these VIEs. You've got, aside from the government doing anything, you're facing company risk in that at any single point in time, you might have your assets taken away from you.
So even if you knew for a fact that the CCP would never touch the VIE structure or threaten it in any way or enforce its current laws against it, yes. While you have a profit sharing agreement with these companies, if you own a share of these VIEs, you don't actually have any management control over the company. So they can
No.
make very self profiting or conflict of interest type decisions, like expropriating from the main company this particularly profitable portion of it to themselves, and you have no control. It's a little bit like owning the maybe a millionth of the profits of Amazon, but having no right to say that Jeff Bezos can't simply walk in one day and expropriate one of the warehouses or take a whole division for himself. Do I have that
Well,
right?
yeah, I mean, I guess if you take Amazon example, Jeff Bezos can make decision. He could sell, AWS out from Amazon without us necessarily agreeing as shareholders if we're minority shareholders, but we stand a legal right to receive our portion of the proceeds from that
Right.
sale. So we would still get the even though we're not involved in the decision, we'll get the
Mm-hmm.
economic benefit of the decision. The problem is with the VIEs is that A, you're not involved in the decision, and B, there's nothing to say that you'll get any of the benefit either. It can just be
Right.
taken
Right.
away from you. Um,
So just to hit on that one last time, it would be like if Jeff could not what he could sell AWS, and obviously we'd think he would get like a good bargain for that if he decided to do that, and we as shareholders would benefit from that. But what he couldn't do is sell it to himself for say $1 or
Correct.
something ridiculous. There's all
Exactly.
kinds of conflict of interest protections here in the United States that we as shareholders would have against such an
Yes.
expropriation of a valuable asset of the company. Whereas in China, there's what you're saying is no such protections exist. If Jack Ma, the head of Alibaba, wants to, write a check for $1 and buy the most profitable portions of the company, it's been proven
Yes.
that basically with a little bit of negotiation with Yahoo cents on the dollar, he can more or less get away with that, is what you're saying.
Absolutely true. And the reason is because you sit in the middle in this VIE, and that
Mm-hmm.
you as a shareholder, let's say you try and sue the VIE, which would then need to try and sue the Chinese company. The Chinese courts just look at it and they say, well, this structure is illegal. It doesn't exist. These contracts are worthless.
Right.
You don't have any rights to anything. So things get very quickly thrown out. And
Right.
people
Right.
end up hitting a brick wall extremely quickly. And it's remarkable how quickly it seems to me that investors forget this fact or simply ignore this fact. If you
Mm-hmm.
think Yahoo and Alipay was only that was 10 years ago, so reasonably recent memory. And Jack Ma was about to IPO Alipay. He's changed the name to Ant Financial now. He was about to IPO it only about 12 months ago, and it was pulled by the Chinese regulators, so they cancelled the IPO. But it was lining up to be one of the biggest IPOs in stock market history. We're talking about hundreds of billions of dollars that US and Western investors were ready to put into exactly the same structure with exactly the same management team that had gone through one of these situations only 10 years previously, which I
Absolutely.
find remarkable. And even Alibaba today, hundreds of billions of dollars of market cap, still in
Yeah.
this company, despite what happened in very recent history.
And undoubtedly, the companies lining up to buy shares of Ant Financial would have resold them, or at least made them available to retail investors, probably without giving a long explanation of the history of how Ant came to be its own separate company, I would imagine.
Absolutely true. And I think there's a real conflict of interest there, in that the US investment banks who do these IPOs and these listings make an enormous amount of money from IPOing and listing these VIE structures. And while there is technically a very small declaration within the documentation, when they file their S1, their kind of pre-IPO prospectus, there will be a small declaration that this is a VIE. To me, I would very much take the view that the risks are not appropriately being appropriately made aware, or people are not accepting them to the appropriate level. One of those two things must be happening from my perspective, the way I see it, for the amount of money that is in going into these companies. Either the risks are being undersold or people are not listening. I don't see how the risk could be appropriately taken on board and this much money go into these companies.
Well, and it could be a combination, right? So it sounds like this is a problem that's been going on for at least a decade, probably earlier.
Yes.
Certainly before the Alipay incident, Yahoo probably had some understanding that this was a risk, or based on their sort of precarious position legally within mainland China.
Yes,
And yet they didn't seem to take it very seriously, and so that probably signals if the supposed I'm gonna take off the I'm gonna play off the famous Enron documentary. If the smartest people in the room don't seem to think this is a huge risk, then it probably signals to retail investors that they should not also be taking it seriously or should not be looking into it. That clearly, which is a real shame, and that's sort of again, bringing it back, why we wanted to have this conversation, because um, these investment companies have a lot of money to be made in simply being part of the transaction, correct? So regardless of what happens to the investor down the line, they're getting management fees and trade fees simply for being part of the buying and selling of these equities. And so they have a
Yes.
real interest in encouraging the
Yes.
trading from US investors in the investment without really having to worry that much down the line. Let's talk a little bit about that. So it sounds like investment companies either are aware of the risk, or certainly should be if they've done even a bit of due diligence. Um,
Yes.
and it sounds
I
like they
think.
aren't really warning customers that much. They put a little something in the S1.
Yeah.
Um, why is it you don't feel? Why do they not feel the need to warn their customers? Obviously, I'm asking you to give your own opinion. There's no way you can step into these people's minds. But if you could
Sure.
pontificate for us a little bit, from their perspective, what is to be gained, and what is, I guess, not to be lost? Why is it they don't have a fear of leading investors astray?
Yes, I'm just going to go up one level if I can, because there's two different types of investment firms, I would say, that operate in a different way, that both have exposure to these and both benefit from VIs existing. First of all, you have the investment banks who physically do the IPOs and list the Chinese VIEs on New York Stock Exchange. These guys get paid IPO fees. There's very much a very clear incentive for the IPO process to continue, VIEs to continue, so they can continue listing them. Had Ant IPO'd, there would have been many millions of dollars of fees available for US brokers to do the IPOs. So I think that's one side. And again, yes, I don't think the risks are either being appropriately communicated or appropriately understood at the IPO stage. The other side of things are the investment firms, and these are the guys running trackers, ETFs, active funds, whatever it might be, really anybody who's then investing in these VIEs once they're listed on the US stock exchanges. Now, for these firms, again, there is a huge incentive for VIEs to exist because it is another product that they can go and sell. Fund houses today, sadly, and this is really one of the main thrusts of the book, is that the vast majority of the financial industry is constructed to sell people products rather than give them specific investment performance. And Chinese companies, China being the largest and fastest growing economy on the planet, the ability to provide investment products that gain direct access to that market is incredibly lucrative. So fund management houses love the ability to be able to create and launch China funds, emerging market funds, whatever it might be. And they can go and sell those and charge management fees and all manner of different things. So they're also very heavily incentivized to go out and market these things. And it's interesting, you take the fund management side, part of when I was going through and writing the article on VIEs, I just did a brief exercise myself and I went through the prospectuses of some of the largest emerging markets or China-specific funds that exist. And these will typically own either all Chinese companies, a lot of which will be VIEs, or they will own a variety of emerging markets countries, of which China will be one. Not once, in not one single fund, did I find a declaration anywhere in the prospectus detailing to investors that investments in Chinese companies would be through VIEs and the risks that are associated with them. So to me, that is a fundamental lack of disclosure from these asset managers, in a sense that they are not telling their end clients what they're invested in. The reason I think that they do that and that they take the view that they're okay to do that is because these are companies that have had the stamp of approval from the SEC to list on the US stock exchange. So there's probably no legal requirement for them to declare the risks to their end investor because it's been stamped by the SEC. And personally, I think we're in a situation where it's been the approach to VIEs has let down. Our approach as the Western regulators, I would say, both in Europe, the UK, and the US, has been poor in terms of protecting investors. VIEs, in my personal view, should never have been able to list on US stock exchanges. They do not provide a remotely sound legal structure. They do not provide ownership of underlying assets, and they open investors up to an enormous amount of risks. On top of that, most of the VIEs in the Chinese companies do not even have to go through the same level of disclosures that other listed US companies do. So every company listed on the stock exchange has very strict requirements of what it has to disclose, audit requirements, etc., etc. The Chinese companies are exempt from those rules on the basis that the Chinese government said, no, we're not going to allow auditors to come in and check our books, so take it or leave it. And what the SEC and the New York Stock Exchange and various other places have done is they have just simply waived those requirements for the Chinese companies. So they are operating on different rules than US companies, which again, I think is a fundamental problem. And we've seen other examples, companies like Luckin Coffee, the kind of the Starbucks of China that was very recently exposed as a very obvious fraud, all based on falsified accounting. That was a great example where companies were not subjected to the same level of audit requirements as US companies. So I think it's that stamp of approval from the regulator that is what gives the fund management companies the confidence that they're free and clear to be able to go out and market these products. I also think we're in a situation of this market has gone on for so long and has become so huge that there is the strength in numbers viewpoint in that for the asset managers, they are facing very little risk in the sense that if you're a big global asset manager and you launch a China fund and the VIE structure is declared illegal and all the stocks go to zero, sure, it's going to look bad, but everybody else also have one as well. So you're not going to look any worse than anybody else. Right. And I think that's a significant problem that we face right now is that it has become so big and has gone on for so long. It's very difficult for anybody to do anything about it. I mean, even Gary Gensler, the new SEC chairman, has fantastically, and I applaud him for this, he's come out reasonably quickly into his tenure and said, if Chinese companies do not adhere to audit requirements, they will be delisted, which is fantastic. The problem is he's giving them 3 years to do it. And these companies should never have even listed in the first place. So the SEC are arguably trying to undo the mistakes that were made 15, 20 years ago. And it's very difficult in the situation they're in now to undo the things that they've rubber stamped.
Right. And in some ways, if they were to act too quickly, they would cause the harm to the retail investor, to the investor in general that they're trying to prevent, right? They want to probably slowly unwind to the extent that there are issues there. They probably want to slowly unwind that, give people time to exit the stocks before they.
Absolutely true. We're in a situation now.
That's the whole thing that they're trying to prevent is people's investments going poof. Overnight. It sounds like to me that these investment firms are basically banking on the idea that if they all fail together, in other words, if it's clear that they've all failed to do due diligence to the same extent, that it will be chalked up as sort of an act of God, that they couldn't have, if every, investment firm, or not every, but certainly you all are an exception, but if all of the major notable ones have been engaging in this kind of activity and suddenly it turns out that these investments, devalue overnight, then they will simply claim that there's no way they could have known. They all, went through the same thing. And it sounds like the SEC has not done the average investor any favors because they've sort of put their stamp of approval or certainly haven't stopped this. And now the current SEC, even if they want to, they've got an uphill battle in trying to unwind this, which is obviously this is not a great position for investors to be in. And I'm going to ask you the very difficult question. Before I do, I will, for your sake and mine, Guy, I'll reiterate that this is not investment advice. We are this for informational purposes. But I'm going to ask you the difficult questions now that we've gotten all the way here is, so with all this information, what should the retail investor do? What can they do to protect themselves from these structures? Are there ways to figure out what's a VIE and what isn't? Are there funds that they exclude them specifically? What kinds of action should the retail investor take if they're worried about some of the risks that we've articulated today?
Yeah, it's a great question. I'm not aware of any kind of any funds or trackers that would give you exposure ex VIEs on the basis that the majority, the lion's share of Chinese companies will fall under the kind of foreign investment rules at the moment. So the majority will be through VIEs. I would encourage investors to, if they're invested in a fund, I would encourage them to reach out to whoever manages that fund and ask them to explain why they're invested in VIEs and what they see the risks are. And it's something that we have done as a firm. I mean, we have no exposure to these, and we also, we run a concentrated stock portfolio here, so it's somewhat out of our remit. But just out of pure interest, I've had conversations with a number of firms who manage these China funds and talked with the portfolio managers and the men and women making the ultimate buy and sell decisions, and said, look, what is it I'm missing here? Why is it you're happy to put billions of dollars of people's assets into these companies? And it's interesting in that, first of all, it was terrifying that there were a number of occasions where even the portfolio managers had no idea that the VIE structure existed, and they had no idea they didn't own stock in Alibaba and Tencent.
Wow.
That was the minority. I will admit most of them knew the structure existed. The most common response that I have received, and the most common answer I've seen as to kind of the pro-VIE camp, is simply that China is moving to deregulate, to open up its borders financially, and this is a legacy historic structure, and that at some point they will remove the foreign ownership rules and allow VIEs as a thing, at which point all of this goes away. And we had the new foreign ownership laws I mentioned in 2020. They've been working on them for the last 10 years. Many people were expecting that in the new draft of the legislation, there was going to be explicit mention of VIEs, or even perhaps that the Chinese were going to decide to legalize foreign ownership. That didn't happen, and the legal ambiguity around VIEs was left very much in the legislation. They did increase the number of companies where some foreign ownership is allowed, which was a good step in the right direction. But for the majority, people are still looking at VIEs as the only option. So, to me, that's the biggest reason I get most often for why these things are okay and why they make sense and why they are attractive for retail investors. And I would make the case that it's entirely possible. It's entirely possible the Chinese government turns around and changes the foreign investment rules, and the VIE structure is either deemed unnecessary at that point, or it becomes legal and is no longer a problem. Sadly, we are very much not in that situation today. And so I think retail investors need to be aware of the fact that, yes, that might happen and everything might be fine. And based on the amount of assets, we're talking about $2 trillion now in the US that sit in VIEs. It's entirely possible that one way or other something works out, because arguably the risk now is so big that was something to go wrong. SEC and the Chinese government need to be extremely careful with it. So it's definitely something that I would say that retail investors should be asking their portfolio managers about, and reaching out to people and saying, hey, why should I be comfortable owning this thing? Why haven't you told me about it? That's going to be the answer I expect they most often receive back in return.
Got it. So it kind of comes down to whether retail investors want to take that geopolitical risk effectively. Figuring out what they're sort of reading the tea leaves as to what the CCP will do moving forward, and it might work out fine if the CCP decides that it's in their interest, or they sort of want to become equal players in the global markets with the same laws, sort of harmonize with the Anglosphere and other countries' stock exchanges. But you're taking that is the main risk, because if they decide to do otherwise, then you're very much at their whims. And so, and that might be the best thing for them. They may like this thing to proceed as broadly legal, or at least broadly recognized, but then they have selective opportunities whenever they feel the need to sort of come in, swoop in, and say, this agreement isn't valid, and we're either taking the company or reorganizing it, that kind of thing.
And I would say for retail investors and for the professional investors managing these funds, the professional investors typically take the view that, yes, they know the VIE structure is illegal and technically is illegal and exposes them to risks, but it's risks they're willing to take because the underlying company is exceptionally fast growing or has wonderful products, whatever it might be. There are many things about Alibaba as an entity, if you take that as an example, that position it as a tremendously exciting company. I think the important thing is, for any retail or professional investor, it's absolutely fine if somebody wants to take exposure and take the VIE risks. I feel it's entirely appropriate if people want to do that. The problem the situation we're in right now is that many retail investors are taking the risks without knowing they're taking them. And so to me, it's a disclosure issue. If people want to take the risk, absolutely fine. Everybody's allowed to do whatever they want with their money, however risky or not. It's the fact that people at the moment are doing it without even knowing.
Absolutely. Well, on that note, I think that's a great way to stop there, because we certainly That's the purpose of this, is to educate retail investors so that they can make those decisions, decide where their risk tolerance is, but do so with open eyes and a full understanding of what they're getting into. Guy, thank you so much for your time today. Before we let you go, where for folks who would like to read more of your work or look into more of what GCI and what products they offer, where can
Mhm.
they find your writings and your company?
Sure. So obviously, we had our book is available on Amazon. Navigating the Street: A Better Approach to Investing. Um, our website, gci-investors.com, contains an awful lot of writings. Myself and my colleagues here, we write reasonably often on stocks, on markets, white papers, the investment industry in general. There's not a lot of information on there. And certainly, I mean, from my perspective, we always welcome conversations about interesting investment topics and interesting things like this. And from my perspective, in terms of how we invest here, I would say, we mentioned that people can take whatever risk they wish. The way we always approach it here is that we're always taking risk whenever we invest, but we would like to take risks that we can understand and appropriately evaluate. A risk like this that is tied to a foreign government that is inherently unpredictable for us as outsiders is not a risk that we're willing to take. Yes, there might be amazing companies in China, but the risk that we're taking is too great to offset that. There are plenty of wonderful investment opportunities available around the rest of the world where people don't need to take that level of risk. And certainly that's the approach that we take. And I would recommend anybody else do the same, in that you can find amazing companies where you don't have this level of kind of legal structure risk.
Excellent. Well, thank you so much for joining us. Audience, thank you so much. And I will just note as we close out, we don't really, generally speaking, at Consumers Research endorse goods and services. We try to just call balls and strikes, but we do endorse educating yourself. And on that, I will highly recommend Guy's book, Navigating the Street. I found it to be incredibly informative myself, and recommend you check out his blog on his website, as he just noted. Guy, thank you so much for joining us. And audience, we look forward to bringing you more content like this on some of the issues in the investing community.
Thanks very much, William.